Today, folks, we're living through one of the greatest bull markets I've ever experienced in my life as a Canadian investing. It's not just the US markets, it is the Canadian markets, it's the global markets, and valuations are extending to levels that have only been experienced a few times in history, driven by the commodity boom. We really want to focus on the AI boom because I think this is the defining factor to this boom and bust cycle. And obviously, in hindsight, time will tell what's going to unfold here with this AI arms race. Now, Sora being the top downloaded app next to Gemini. And we need to talk about Sora's recent updates because we are now just maybe another generation or two away from upgrades in this AI software to actually being able to fully generate media that would entertain us. And the simple prompts that are driving this are truly mind-boggling. I noticed CoffeeZilla here made a video and he says the only thing standing between this AI and the future is lawyers because they're really ripping a lot of IP. I don't know what the legal side of this is really about, but we're going to dive into it. So if you're on a path to financial independence, if you love exploring the markets and just openly discussing where we're going from here, as we will review more in depthly my accounts, join me on your journey. Hit that subscribe button, folks, because if you didn't see this, you got to take a look.
Your hands on the wheel! You almost wiped out 3 cars back there! Put it in park, now!
I'm sorry, officer, I just...
Don't move, door's locked, unlock it right now!
I can't get a ticket again.
Hey, stop the car!
Now, I gotta be honest,
It is truly funny. Even he's like...
First time I saw this video, I was pretty amused, but...
It is super amusing, but it goes beyond this, right? Like, we're fully generating AI clips now of, like, even Rick and Morty, Family Guy, like, we've seen this.
Things, and it's...
Swinging! I can see the gigantic sword, Morty. Thank you for the play-by-play.
Oh my God, the health bar. Why does he have a second phase?
I'm out of...
So look, you just have to...
Like, it's crazy, right? And these are very simple prompts. Like, I think there was one with, like, Star Wars and Family Guy, and the guy basically just said, I just want a comedy skit with, like, Star Wars, Family Guy, and that's kind of what happened.
Family Guy, complete with their voices and, you know, animation.
Bad feeling. And not the cool movie kind. More like when you eat gas station sushi.
You had a bad feeling before breakfast, Peter. You said the toaster was looking at you funny.
Yeah, well, it was.
The guy who generated this, by the way, said he just put in Family Guy, Star Wars joke. We're actually so close. 2 to 4 more good iterations and no lawsuits, and I'm generating all my entertainment.
This is insane. And the worst part about this is we're only paying attention to the video side. I mean, the VO3 from Gemini or VO2, whatever that was, that upgrade was wild. Now we're getting this, but we're not even talking about Excel. Like, the AI for Excel now is crazy. Coding. I mean, even still, like the Gemini assistant or the AI assistant from Google that can literally go across your apps and do things for you. Yeah, we're living in a world right now where it's really hard to wrap your mind around like what's going to happen and how this represents to valuing the markets. And I've been telling you guys that we are in a peculiar time where a lot of people are calling the market incredibly overvalued, but I can point to many different sectors where valuations don't actually seem that stretched. I've talked about this with Apple, Microsoft, maybe Nvidia. Like, these companies are very expensive for the growth we're getting. But when you talk about the financial sector that's trading at record highs, they're going through a news cycle, especially here in Canada when it comes to loan loss provisions, the commodities market. And I want to break this down a little bit more in depth, please. So again, if these are conversations you enjoy, hit that like button, folks. I'd love to know your opinion surrounding this. And before we get into the valuations on the ETFs that I'm holding, I should point out that the portfolio performance has been nothing short of astonishing here. I'm still able to outperform the broader markets as one of the few influencer clowns on this platform. I'm not just going to show you a put together spreadsheet, guys. Like, I'm actually pulling up the performance behind the accounts. These are from the bank. I can't manipulate them. I mean, you can see basically this account, my TFSA, since June of 2017 to September of 2025 is now up almost 300%. We are 1% away from a 300% return, whereas the S&P's only returned 177%, largely driven by the trade with Google we made. I mean, we did quite a lengthy swing trade there. We were buying Google, cost averaging on the dips, and when it got up to my fairer valuations, I just scaled it down because it became such a ballooned position in the portfolio, and I took profit and repositioned it in my TFSA into the S&P 500, buying more VDY. If we take a look at my registered retirement savings plan, this account up 351%. Just since 2019, you know, the S&P is only up 124%. Again, this is going way back to Tesla era. In fact, I probably could have kept Tesla, and at this point might have been better off. Tesla is just flying to the moon for God knows what reasons these days. I'll have to do a deep dive on that in a moment. And then, of course, my corporate account. This one's been a bit more dodgier. And again, I'm going to be fully transparent here with you guys. I do hold a variety of small cap stocks I don't talk about as frequently. Some of them are crushing it like a Duro. Some of them aren't doing as well. But even still, with me scaling out my larger positions that I tend to talk about, about on this channel. My corporate account, since being around since May of 2021, is now outpacing the S&P. It's up about 70%, whereas the S&P in the same time frame is up about 64%. If we look at all my major holdings, regardless though, the ones that have the highest impacts on the portfolio, you can see why I mainly focus. The description I love to put in people's mind is focus on the few and cost average into the many, because regardless, when you start picking individual stocks, you're going to increase a lot of volatility in your portfolio. And I know people are getting comfortable with the higher valuations we're experiencing, but again, if we go into another very volatile down market, you could see some of these stocks drop as much as 70 to 80+%, if not going bankrupt, depending on the trends that are going on, which we've seen. I mean, like you go back and you look at the trends of like, oh my God, even just 2021, right? With like NFTs, the very good butchers, Beyond Meat, like all those stocks and trends that seem very promising did not work out. And that's just because they're still companies. Some of them are still generating revenue, but they pulled forward just way too much of their valuations. And that's the fear of what's kind of going on now, which is why you'll see the few stocks I've focused on to make them materially bigger in the portfolio between my fiance and I is Google and Meta, because their valuations make more sense. I think they have more growth ahead of them for the value that I'm paying. And then if we also look at what I'm buying, like this is why I'm not generally cost averaging into the broader Canadian markets, is because I get a better value on the dividend payers, even though they're at a more expensive period in their cycle. I'll remind you, VDY right now is only trading at well, again, keep in mind, it's probably closer to a 16 or 17 at this point. I think these valuations go back to how far ago is this? I think the last update, viewing September 30th, 2024. Actually, no. So risk and volatility as of August 31st, 2025. I'm presuming that falls in line with the valuation credentials here. We're probably up, obviously, since the end of August there. But yeah, regardless, if you remove the growth stocks like Shopify, Constellation Software, and a lot of those high flyers in the Canadian economy, I just like focusing on the dividend kings here, and then focusing on the major AI players in the United States over Canadian technology, because Canadian tech companies always trade at just absurd valuations for no reason. And I think it's just because there's so few tech companies in Canada that when you're allocating toward a Canadian portfolio, people might be over allocating to the tech sector in that sense. But regardless, the valuations on VDY might be a bit higher than the averages, but still at a level where I'm comfortable knowing, going through these companies, seeing the growth rates that are ahead of them, future expected values, the return to earnings per share from provisions for credit losses, knowing that this is 50% financials. Like this is mostly a financials ETF with, Royal Bank TD being 25% of this entire portfolio. So, and I can easily look at Royal Bank, Toronto Dominion, and Bridge and get a clear sense that, yeah, they're not cheap, but they're also in a very good growth phase in their histories, right? If we take a look at the S&P 500, this one as well, the valuation goes back to only 08/31. So we're about a month or two behind, which I don't like seeing considering how much we've been up in the last month or two. And we can see the price to earnings on VO right now is 27.7 times. But we'll come back to this in a moment. I do want to remind you, the S&P has a growth rate right now of 23.8%. If that remains, I'm telling you guys, I don't think it's unreasonable to pay a 20 to 30 times multiple if the underlying assets are growing at a 20 to 30% clip. That's actually, I wouldn't define it as being crazy overvalued. I mean, these growth rates, again, are quite astonishing. Return on equity is quite astonishing. Like the S&P has been a true marvel, but we get it, right? Like you got to understand, we're trading at a 31 PE. I think if we look at the forward price to earnings multiples, we're still trading at like a 23 level. The forward multiples are the only thing that are giving me a little bit of comfort, knowing that if we go into a correction, I think a 20% correction would bring us to a healthier state. And we went through it in the Terrafor, and I wish we lived down in those levels for a bit longer so I could keep buying. I mean, yeah, it's fun, obviously, watching your accounts balloon up to like, 500K out of nowhere. But at the same time, it's like, I'm not done buying, guys. It kind of hurts my soul a little bit. If we look at the Canadian side, however, if, again, you're not looking just at VDY and you're looking at the broader Canadian markets with those upper weighted tech companies, we're trading at close to a 20 times multiple. And comparably in the world markets, guys, these are levels that Canada really hasn't seen since the .com level. And again, you're going to have to decide yourself if this is too extreme for your comfort level and if it's worth looking at GICs, which if you're Canadian, I don't think there's anything wrong with parking a percentage of your capital into money market funds. At least in Canada here, you can still get GICs a little bit longer term at around 3.5 to close to 4%, I believe. I noticed some private companies when we were talking about like MCAN Mortgage Group, they were offering some pretty reasonable GICs. But regardless, yeah, you got to be a bit careful here, guys. If we broad view what stocks are crushing, I think tech is the only marvel that we're going to be discussing for some time outside of commodities. Those are the two defining factors, I think, to this bull market. I mean, you got to recognize, right? Like the tech boom here is insane. I mean, Oracle's up 70%, Palantir's 127, Nvidia's up another 40% this year. If we look at the Canadian side of the border, again, financials, that for the Canadian markets, I think financials are going to be a marvel, but obviously the shining story is precious metals. I mean, we've got gold here getting pretty close to approaching 4,000 an ounce. It looks like silver is going to push $50 here, and it's not stopping the train. I mean, we're year to date up over 100% on some of the largest gold companies in the world that exist in Canada. I mean, that is nothing short of just absolutely astonishing, right? So if that helps drive some of the valuation compression, then you can't say that we are particularly in this kind of overvalued AI market. If you go back to 2022, again, NFTs, there's so many exemplifiers of speculation that kind of just busted. But in this cycle, we're starting to feel the same sense, right? I mean, we're seeing overvaluations in companies like the big tech stocks. We're starting to see crazy valuations and people making really what I would consider silly investments in like these covered call ETFs when it comes to things like yield max. I mean, we're starting to see people get very comfortable doing things that most people would define as incredibly risky, yet people are shrugging it off as though it's not actually a risky investment style. And I think there's going to be some exemplifiers when we do go into the next correction and when some of those things start to ebb and flow again. But regardless, you got to figure out what your core portfolio is, your ride or die, buy and hold forever so you can get through these market cycles. Because again, we're getting quite comfortable in a market where, again, guys, eventually the chickens will come to roost. But I'm more curious to see what happens and when the valuations start to make sense around these AI players, because obviously when it comes to OpenAI, I mean, these are incredible tools, but we don't know what the real valuation of it truly is, and we know it's expensive. I mean, I think it's been valued at $1 trillion company or something because it's private. I mean, you look at like Google and Meta, yet somehow trade at way lower multiples and aren't actualizing a lot of the AI value yet. I mean, obviously there's huge promise and we're expecting that promise, but when you can't correlate it to ones and zeros, it's like looking at Tesla's valuation. Like at some point you have to say, I might be crazy because I could be pricing in like billions of dollars worth of earnings potential that just haven't actualized yet. So I'm not sure exactly what to do here, guys. And obviously, like, I've invested heavily this year and I'm just trying to take a breath back. And I'm not like going crazy stacking cash, but I told you when markets do this, I tend to want to focus more on paying down the mortgage and just kind of do this back and forth ebb and flow thing. I'm still cost averaging, don't get me wrong. But again, like, when you're starting to see your counts go up by this much, guys, you're kind of like, I'll just let it do its thing for now. And if the markets take a major dip, hey, I'll start investing a bit heavier. But for now, like I said, I'm going to just hammer the mortgage, keep putting some money in those accounts, try and drain it down into next year. And we'll kind of see where we're at as we head toward the holidays. But I'll pass the question off to you. I'd love to know what you think about all of this in that comment section below.